Compound interest is often referred to as the eighth wonder of the world, and for a good reason. It is a powerful financial concept that can turn modest investments into significant wealth over time. By earning interest not just on the initial principal, but also on previously earned interest, compound interest accelerates growth and creates a snowball effect. Whether you're saving for retirement, building wealth, or just starting your financial journey, understanding how compound interest works can help you harness its full potential. This guide will explore the mechanics of compound interest, the factors that influence its power, and strategies to use it effectively to grow your wealth. 1. What is compound interest? Compound interest is the process by which interest earned on an initial investment, the principal, also earns interest over time. Unlike simple interest, where interest is calculated only on the principal, compound interest involves reinvesting earned interest, leading to exponential growth. For example, if you invest $1,000 at an annual interest rate of 5% compounded yearly, your investment grows as follows. Year 1, $1,000 times 5% equals $50. New total, $1,050. Year 2, $1,050 times 5% equals $52.50. New total, $1,102.50. Year 3, $1,102.50 times 5% equals $55.13. New total, $1,157.63. Notice how the interest earned each year increases as the total balance grows. This compounding effect becomes more dramatic over longer time horizons. 2. The formula for compound interest. The compound interest formula helps calculate the future value of an investment. A equals P times 1 plus R, N, NTA equals P times 1 plus R, N, caret, NT, A equals P times 1 plus R, N, NT where R equals future value of the investment, loan P equals initial principal, R equals annual interest rate, in decimal form, N equals number of times interest is compounded per year, T equals time the money is invested or borrowed, in years. This formula demonstrates how time, rate, and frequency of compounding influence the growth of an investment. 3. The power of time. One of the most significant factors in compound interest is time. The longer your money has to grow, the greater the compounding effect. This is why starting early is critical for maximizing wealth. Starting early versus starting late. Consider two investors, Alex and Jamie. Alex invests $5,000 annually from age 25 to 35, 10 years, then stops contributing. Jamie invests $5,000 annually from age 35 to 65, 30 years. Assuming a 7% annual return, Alex ends up with more money by age 65, despite investing for only 10 years. This illustrates the compounding effect of starting early and letting investments grow over time. 4. The role of interest rates. The rate at which your investment grows significantly impacts the outcome. Higher interest rates amplify the compounding effect, leading to faster wealth accumulation. For example, at 5% annual interest, $10,000 grows to approximately $16,288 in 10 years. At 7% annual interest, the same $10,000 grows to around $19,672 in 10 years. Even small differences in interest rates compound significantly over time. Maximizing returns. To achieve higher rates of return, consider investments with strong growth potential, such as stocks. Historically offer higher average returns compared to bonds or savings accounts. Index funds provide diversified exposure to the stock market with lower risk. Real estate can generate consistent returns through appreciation and rental income. Balancing higher risk investments with safer options is crucial for long-term success. 5. Frequency of compounding. The frequency with which interest is compounded also plays a critical role. The more frequently interest is compounded, the faster your investment grows. For instance, annually, interest is compounded once per year. Quarterly, interest is compounded 4 times per year. Monthly, interest is compounded 12 times per year. Let's compare $1,000 invested at 5% annual interest over 10 years. Annually compounded, $1,000 times 1 plus 0.05, 1, equals $1,628.89. Quarterly compounded, $1,000 times 1 plus 0.05, 4, to the power of 4 equals $1,645.31. Monthly compounded, $1,000 times 1 plus 0.05, 12, squared equals $1,647.01. Although the differences may seem small initially, they become more pronounced with larger sums and longer time frames. 6. Strategies for harnessing compound interest. Start investing early. Time is your greatest ally in compounding. Starting even a few years earlier can significantly increase your wealth due to the exponential growth of your investment. B. Contribute consistently. Regular contributions amplify the compounding effect. By investing consistently, you build momentum and take advantage of dollar-cost averaging, which reduces the impact of market volatility. Century Reinvest Earnings. Reinvesting dividends, interest, or other earnings ensures that your money continues to grow. This is especially important in dividend-paying stocks or mutual funds. D. Prioritize high-interest accounts. High-yield savings accounts, certificates of deposit, CDs, and investment accounts with competitive returns allow your money to grow more quickly. E. Minimize fees and expenses. Management fees, transaction costs, and other expenses can erode your returns. Opt for low-cost investment options like index funds and ETFs to maximize your growth. 7. Real-life applications of compound interest. Retirement accounts. Compound interest is a cornerstone of retirement savings. Accounts like 401ks and IRAs allow tax-advantaged growth, which accelerates the compounding process. Example: investing $500 monthly in a retirement account at an 8% annual return can grow to over $1.2 million in 40 years. B. College savings plans. Education savings accounts, such as 529 plans, benefit from compounding and tax advantages. Starting early ensures sufficient growth to cover future expenses. Century Paying off debt. While compounding is beneficial for investments, it can work against you in the form of high-interest debt, such as credit cards. Prioritize paying off high-interest debt to avoid its negative compounding effects. 8. Challenges and risks. Inflation. Inflation reduces the purchasing power of money over time. While compound interest can help offset inflation, it's essential to aim for returns that outpace inflation rates. B. Market volatility. Investments in stocks and mutual funds are subject to market fluctuations. Maintaining a diversified portfolio helps mitigate risks while still benefiting from compounding. Century Patience and discipline. Compound interest takes time to deliver results. Staying disciplined and avoiding impulsive decisions are critical to maximizing growth. Compound interest is a transformative financial concept that can turn modest savings into substantial wealth over time. By starting early, contributing consistently, and choosing investments wisely, you can harness its power to achieve your financial goals. Whether you're saving for retirement, education, or other long-term objectives, compound interest provides a reliable path to wealth accumulation. With patience, discipline, and a commitment to reinvesting earnings, you can watch your money grow exponentially and secure a brighter financial future.